Right now, Nuburu Inc., ticker BURU, is trading at $33.72. That's down about 3.27% on the day as of 10:27 a.m. Eastern. It's moving on absolutely massive volume, with over 14 million shares having already changed hands. Now, seeing a 3% drop on a 33-cent stock might not seem like a big deal, but that is not the story here. The immediate expectation for a stock this low, this close to the bone, is that it's on a one-way trip to delisting, just bleeding out. But the reality is that this trading activity, this volatility, isn't the sign of a company dying. It's the sign of a company in the middle of a frantic, high-stakes attempt to completely change its identity. This isn't a slow bleed, it's a battlefield. The company is in a race against its own balance sheet, trying to pivot from a niche laser maker into a full-blown defense and security contractor, and it's doing it by acquiring other companies at a rapid pace. Most people who are new to online investing, maybe using a simple platform like the Robinhood app or SoFi Invest, look at a sub-dollar stock like BURU and see a lottery ticket. The expectation is simple. It's so cheap, it could easily go to $3. They might see the company's description of blue laser technology and think this is some undiscovered high-growth tech play, a pre-boom Nvidia stock, or the next Tesla stock in the making, just for a different industrial sector. But the reality couldn't be more different. This is not a simple, clean growth story. This is a complex, messy, and urgent corporate turnaround. This isn't the kind of stock you add to a diversified long-term portfolio like Schwab Intelligent Portfolios. This is a pure, high-risk speculative play based on management's ability to execute a radical strategic shift. This is the kind of ticker that serious traders using interactive brokers are watching, not for its long-term disruptive potential, but for the short-term volatility generated by its constant stream of news, its financing deals, and its fight for survival. This is a world away from the stability of an Apple stock or the core holdings you'd find in Fidelity Wealth Management. Let's look at what is actually happening. The market is trying to digest an absolute flood of information that has come out of this company just in October. On October 22nd, Nuburu announced a strategic alliance with Maddox Defense. This isn't a small-time deal. It's a non-binding agreement to form a controlling interest joint venture to build military-grade drones for NATO customers. Nuburu is committing to fund this with up to $10 million. Just before that, on October 7th, the company announced it was acquiring a company called Orbit, a software-as-a-service provider specializing in operational resilience. And all of this is part of a larger stated plan to build a defense and security hub, which is centered on its ongoing acquisition of a company called Tekne, an Italian firm that reportedly has a tactical bubble product for anti-drone and electromagnetic warfare, and which Nuburu claims has a $500 million order portfolio. This is an all-out sprint to bolt on new business lines and, more importantly, new revenue streams. This entire transformation is being funded by capital raises, which brings us to the other side of the coin, dilution and financial health. In mid-September, Nuburu completed a public offering that raised $12 million. As of the end of September, the company reported having about $6 million in cash specifically to deploy for this acquisition program. This is the classic microcap dilemma. The company needs cash to grow, or in this case, to acquire growth, but the only way to get that cash is to sell stock at very low prices, which dilutes existing shareholders and puts more pressure on the stock. This is why the volume is so high. You have one camp of investors, likely day traders and speculators on platforms like the SoFi trading platform or using Robinhood fractional shares, betting that these acquisitions will create a company worth far more than its current $45 million market cap. Then you have another camp that sees the constant dilution, the cash burn from its core business, and the massive execution risk of trying to integrate 3 different defense companies at once, and they are selling. This brings us to the biggest shadow hanging over Nuburu: its exchange compliance. This is a critical piece of the reality that many new to online investment might miss. On October 13th, the company received a warning letter from the NYSE American Exchange. Now, this specific letter was a slap on the wrist, not for its stock price, but for the way it announced its new dual CEO structure, basically a procedural violation. The company announced on October 16th that it had restored compliance on that matter, but that's not the real threat. The real compliance issue stems from April 2025, when the exchange warned Nuburu about its low stockholders' equity. The company submitted a plan, which the NYSE accepted in July, giving it an extension until October 29, 2026 to fix its balance sheet. This is the ticking clock. Management has a 2-year window to use this $12 million and its $100 million shelf registration to acquire and integrate these defense companies, make them profitable, and fix the underlying financial weakness of the consolidated company. If they fail, they will be delisted. This isn't a story about lasers anymore. It's a race against a calendar. When you look at who actually owns this, the reality becomes even clearer. This is not a stock that big, sophisticated funds are buying into. Institutional ownership is almost non-existent at just over 1%. And the largest holders are not active high-conviction managers. They are index funds like Vanguard's VEXMX or Fidelity's FSMX and FCMX. These are Fidelity mutual funds and Fidelity ETFs that are part of a total market index, meaning they are forced to own a tiny sliver of Nuburu simply because it's part of the index. This is the opposite of a high-conviction buy. There is no major Fidelity brokerage arm or other large institution building a position. Insider ownership is around 8 to 9%, so management has some skin in the game, but the smart money is firmly on the sidelines, waiting to see if this gamble pays off. This is a retail-driven stock, which is why it's so volatile and so susceptible to news. This is the kind of stock that requires constant investment help, not a set-it-and-forget-it holding for an individual brokerage account. So what does Nuburu even do? Or rather, what did it do? The original company, the one that went public, was built on a very specific high-tech product, a high-power blue laser. This technology is genuinely interesting. Because of its specific wavelength, it's very effective at welding and processing metals like copper and aluminum, which are notoriously difficult for traditional infrared lasers. This gave it potential applications in battery manufacturing for e-mobility, consumer electronics, and 3D printing. The expectation was that this superior technology would find a massive market. But the reality, as shown by its recent financials, was a struggle. The Q2 earnings report in August showed a massive miss on earnings per share, even as it beat revenue. The revenue was tiny at $1.74 million. This struggling core business is the reason for the desperate pivot. The blue laser technology is not being abandoned, but it's clearly no longer the central focus. The new focus is the Nuburu Defense Hub. The company is projecting this new division will start billing its first $500,000 in the fourth quarter of this year. That's the first test. This is a massive strategic shift, and it leads to the central question for anyone looking at this stock. Comment below. Do you think this pivot into defense is a brilliant move to save the company by buying new revenue streams? Or is it a desperate, high-risk gamble that is just lighting its remaining cash on fire? Looking forward, the entire thesis for this stock has changed. The old expectation was that Nuburu would one day announce a massive contract for its blue lasers from an automaker or a battery manufacturer. That's no longer the primary catalyst. The new reality is that the future of this company rests entirely on its M&A strategy. The key catalysts to watch are 1. The successful closing of the Tekne and Orbit acquisitions and the finalization of the Maddox JV. 2. The successful integration of these companies. It's one thing to buy a company, it's another thing to run it profitably. 3, and most importantly, tangible revenue growth. The market needs to see that $500,000 in Q4 billing turn into millions per quarter, and it needs to see it fast. The risks are equally clear. The deals could fall through, the integration could be a disaster, and all the while the company is burning cash and that 2026 NYSE compliance deadline gets closer every day. This is not a simple investing sites pick. This is a binary bet on a complete corporate overhaul. So, as Nuburu trades at 33 cents, the surface expectation is that of a failing microcap, another tech company that didn't make it. But the reality is that this is one of the most aggressive and dramatic corporate transformations you will find on the public markets today. It is a high-wire act. Management is attempting to shed its old skin as a niche laser maker and grow a new